ShadowTrader uncovered. ShadowTrader Studios.
All right. Anyway, all right. Let's rock and roll. This is something I've been excited to do for a while. Top 10 future setups. Linda, if we could please drum roll and the first slide, which will show us the title screen here, which is called Day Trading Future Setups. And then underneath it, you can see it says Trade Types. Linda, we're good with the slide? Not hearing. Oh, it's beautiful. All right, cool. Okay. Trade types, and I wrote, all opportunities must be able to be quantified by being one of the following. And the following are simply 10 different scenarios, setups, basically, for lack of a better word, of what the ES futures and the market profile, value area, etc., those types of inflection points or technical inflection points should be doing in order for you to effectuate a trade in the futures. And one of the important takeaways of this whole thing is that if that's what you want to do, if you want to just day trade futures, and I talk about this because a lot of people do, and you just want to do ES or whatever, it's very, very important to have a framework of what you actually do, as opposed to just coming into the market, sitting down willy-nilly and being like, oh, I'll short it here, I'll buy it there, and yeah,
you're just kind of guessing.
You're just kind of guessing or whatever. So if you have specific trade setups and you only act when those setups occur, well, then it's just a question of discipline of just waiting for those setups, and then you just keep very, very complete records of how those setups acted, what type of context was happening at the moment when that was so setting up, because of course the context is king. And you go forward from there, and you get a really, really good idea after a few months of doing this of what's working, what's not working, what situations make the trades work out and what ones don't. All right,
that makes perfect sense.
Exactly.
So just because you see a setup, there are criteria that must be met,
of course,
to actually take that trade. So I want to again make that very, very clear. That what we're going to go through requires confirmation.
Right. You're exactly right. And some of the majority of the slides that we're going to go through talking about these 10 setups, you'll notice in the fine print that we're going to go through, I will be telling you what the context has to be in order for that specific trade to work out. Obviously, in the heat of the battle, every contextual situation looks different, but to give you an idea of what things need to look like. All right, so slide number 2. And I will just close this off. All right, very good. Slide number 2 is up, which is our first idea. Oh, can you mute that up there?
Oh, sure, of course.
Thank you. All right, very good. All right, so number 1, first type of trade. Fade the extreme of the value area if from a starting point within the value area. So what does this mean? Tells you essentially that you're inside of the area where 70% of yesterday's futures volume went off, basically. You are inside of it. This tells you right off the bat that you are probably in a choppy market because you are inside of value. Dalton refers to this as a market that is in balance. Wherever all that value traded yesterday, you're at the same area, so you're in balance. I like fading the extremes of the value area if I start from within balance because I probably get the market to bounce off of there back and forth from within that balance.
Now, this is a perfect example. Does today's setup work for that rule number 1?
Absolutely not.
Absolutely not.
Absolutely
there you
not.
go. So this is good. I mean, unfortunately, we don't have, every single chart that we could show you to match these setups. But
exactly.
I want you to
today
think
would
about
be a good
it.
example. That's right. So, continuing onward. Internal should be mixed or not in trending mode, and tempo should be relatively slow. So exactly to Brad's point, what he was just saying, today is not the day for this type of trade. Absolutely not.
We've got big tempo to the downside.
You've got fast tempo, and the market is in trending mode. You're having a trending day, so you would probably not do this trade today. The odds of success increase if there is already some value built within the value area and the market breaks towards an extreme later in the session. What does that mean? What this does is gets you to be able to avoid early momentum. So basically, sometimes you'll start out inside of the value area and quickly have what's called an initial drive and break towards one end of the value area. That's a little bit harder to trade often because the market is moving faster. That's fast tempo. So what I mean when I say the odds of success increase if there's already some value built within the value area, meaning that you were in balance in this area yesterday, now you're balancing there again, perhaps a half hour, 45 minutes, perhaps an hour has gone by, and the market hasn't been able to break towards either extreme. Okay?
Great point.
Odds of success decrease if the market breaks toward the value area extreme early. Just got finished saying that. Market internals show the underlying strength or weakness of any particular move and define the odds of that move continuing through the next inflection point or rejecting or stalling. Should be obvious, right? You do not want the internals to be, for instance, overly bullish if you're fading the top of the value area, or overly bearish if you are fading the low end of the value area.
Right.
You want more of a mixed bag so that the push-pull of the sectors, of some sectors that are up, some sectors that are down, some stocks that are up, some stocks that are down, that push-pull is going to work in your favor because that area on the outside of the value area is going to resist. There's going to be some sellers already waiting.
And there's going to be support. Yeah, exactly.
Exactly.
It makes a lot of sense because some days, most days aren't like this. You know, most days are not big trending days like we have today.
That's right.
So that's why these 10 setups are perfect for kind of any market situation.
Right, exactly. All right, let's move to the next slide, please, Linda. This is going to be trade number 2. Okay, very good. Trade number 2. Buy the high or sell the low of the value area if you are starting outside of the value area. Okay, so think about it. You have a value area from the prior day. The market has now gapped and is above it. Usually this works better on a gap.
That's right.
Or is gapped below and is now below it. Internals should be positive if buying, negative if selling. This is very, very key. Very often you will get a gap. The gap will be above the value area, right? The market will then come in off the gap. It will stop at value area high. But this will be happening in an overall situation where the internals are bullish, telling you that the initial move down is nothing more than a liquidation break. The weakest hands from the overnight session needed to clear themselves out. They dumped their position. When you come down to value area high, where there's some real players there from yesterday, right? Real players who are long for, they don't sell so quickly. New buyers come in and you get a bounce. Right?
Perfect.
So it should be apparent that the internals and the tempo do not support a larger move into the prior day's value. So again, same thing. Internals kind of middling, no real push to the downside or upside, no major momentum. Right. The market wants to reject balance and establish value elsewhere. That last point I just put in to say that's essentially what the market is doing, right? If the market comes down to value area high from above, it's rejecting the balance area and is telling you, I want to establish value higher. Therefore, bounce at that low and value will probably establish higher. All of these trade ideas and trade setups have a lot to do with visualizing where value is going to be later in the end of the day.
Right.
A lot of them do that. And that's hard to do, again, in the heat of the battle early in the day, but it can really help you a lot if you really think that through and think, okay, if we reject it at the value area high here after a gap, where's value probably going to be later? Is there an area I can get long here? If not right at the value area high, maybe another entry or whatever, because I believe value is going to establish higher.
That's a great point.
Yeah.
And same thing for a gap lower. You know, any kind of fade back to the value area low. Again, short hands, weak hands getting taken out. New sellers come in, accepting price at lower levels.
Exactly.
So,
exactly. Just the opposite, basically,
Exactly.
of the other trade. That's right. Okay, Linda, next slide, which would be trade number 3. Okay, very good. Buy the breakout from the value area if you are starting inside of the value area. This is a little bit tricky and requires that the market is sort of building pressure and having a little bit more momentum. But very often you will see the market hanging out in the value area, and maybe you do the first trade where, for instance, you were inside the value area, you did trade number 1. You moved to value area high, you faded it. Market came in 2-3 handles, you took your profit, right? But what if the market then rises again, goes back to value area high? Could it be setting up trade number 3, which is to buy a breakout from the value area from starting inside?
And this is the best if we've had a couple days of balance, because that tells us
exactly
balance, 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 boom, now we're breaking out.
Good point, good point. It gives it more pressure. That's right. So again, points underneath. Internals must be positive if buying and negative if selling. Very, very important. Do not expect that the market is going to break out of value just because you see it on a profile chart. Even if you have the aforementioned pressure building up, you need to have positive internals for a long, negative internals for a short. there must be a small counter move upon the first touch of value area high or value area low to build pressure.
Yep.
We just
Which
got
you were
through,
just saying,
got through talking about that, right? You want to basically go up once, touch, fall back, go up again, then you buy that second touch, thinking to yourself, okay, now after touching it once, coming in, we're going to push out of it.
Yep.
Important. Do not buy a coming up from the bottom or coming down from the top. What does that mean? If the market has already traveled a long way from value area low and is in a rotational situation, meaning it's rotating from low all the way to high, you do not want to ever buy that first touch of the high because the market has already gone too far. So think about that. That's called coming up from the bottom. If it's happening the other way, it's called coming down from the top, basically. You would not buy the, you wouldn't do it the other way, coming down. You wouldn't short the value area low if you were coming from the top.
And that basically means that you had the opportunity to trade the number one setup. You're buying the value area low or you're selling the value area high, really.
That's
so
right. That's right.
Yeah, so
that's right.
Yeah.
All right, we've got to take a short break, and when we get back, we're going to go to trade number 4. All right, so
Awesome.
we'll take a 90-second break. This is Shadow Trader Uncovered, live on the Tasty Trade Network.
See ya.
Let's be honest, staying fit is tough when all you're exercising is a covered call. So join me for this special series of workouts designed to help you stay in shape while you stay at your desk. Welcome to Exercising Trades. Hi, and welcome. I'm Sparkle Spreads. When it comes to fitness, what do you think the most overlooked part of the body is?
The elbow.
No.
The gizzard?
No, I'm not talking to you.
I thought you were...
It's the face.
That was my third guess.
Regular old tape, the kind you probably have lying around your office, provides an easy way to tighten the facial muscles while you trade. As these before and after stills show, this simple exercise can take years off your face in a matter of weeks, and it's so easy to do. And remember, if you're having trouble placing the tape on your own face, get a friend to help you. Oops, you missed a spot. Thanks again for watching. I hope you found it educational. And remember, exercise your trades.
ShadowTrader Uncovered. ShadowTrader Studios.
All right, good afternoon.
Welcome back.
Welcome back, Shadow Trader Uncovered. We are in the middle of the top 10 ES trade setups for futures. So just quickly, we'll do a rundown of the internals. Nothing changed here. Very bearish. We broke down to some new lows about a half hour ago. 14-to-1 negative almost on the NYSE. 13.61 is the exact number. 4.64 to 1 negative on the NASDAQ. I'm kind of surprised, Brad, that the NASDAQ breadth is not weaker, but I guess LinkedIn is holding it up. Right?
Yeah, well, we
LinkedIn's
got
up
LinkedIn kind of helping, but the AD line, I think, when you see it down almost 2,000, that's very significant. We hardly ever.
I'm just talking about just that
Yep.
NASDAQ breadth. Only 4.66 as opposed to the other one being almost 14.
Yeah.
As you were saying, AD lines pegged both sides at minus 2,000. Basically, tick distribution is negative. Core sector list is 25 over 0. We don't get that read very often. Measuring from the open, all sectors down that we watch. Jumbotron stocks all down, all in the red, except for LinkedIn. It looks like Chipotle is getting massively beat up, and so is Priceline.
Google, Priceline, getting rocked, Chipotle.
Priceline, yep. And now, boy, aren't I happy that my Priceline bet was the zero debit ratio spread with the short at 1035, which is going out worthless today. And then even if those upside calls go out worthless, doesn't matter. I paid nothing for the spread, so no loss here, even as Priceline is falling apart. That's kind of the trade to be in, I think, for this. All right, let's go back to our futures setups here. We're going to get into the fourth trade now. So slide, please, of trade number 4. All right, very good. Now it gets a little trickier because you'll notice that I have a number of more bullet points here to talk about. Okay? Trade number 4 is to fade an opening gap when the overnight low or the overnight high fails to get taken out in the opening drive. You should always use a 24-hour chart for futures so that you can mark off where the overnight high and the overnight low is. If you got profile software, you can obviously see the distribution of how the overnight area looks, etc. I always give a snapshot of this in my blog every single morning at shadowtrader.net. Here are the bullet points underneath. 1, gap must be less than 10 points on the ES. This is important because very often the larger gaps are very, very tough to trade early. Even if they don't take out the overnight high or the overnight low in the opening drive, they're just tough to trade. It's rare that you get a market like today where it just kind of started going down right away and, gap and go. Usually big gap, problem at the open, 2 hours of consolidation, back and forth, screws with your head, and where's it going to go? All right. Overnight inventory must be at least 90% or more net long or net short. What does that mean? At least 90% of the overnight action, if it's a gap up, should be above the prior day's settlement. If it's a gap down, at least 90% of the overnight action should be below. Again, snapshot posted in the blog every morning showing the distribution of the overnight action from 4:15 p.m. up to 9:30 a.m. the next day, showing you where that overnight action is. You'll have better odds if you have inventory very, very net long on a gap up. Let's say you gap up 7, it generally needs to correct. Remember, always think in terms of the overnight inventory as being weak hands. Those are the momentum players, the weakest of the weak. They will not hold for any sort of big gain. They want to get out of that position very close to the bell ringing because they want to take that profit or protect that profit if the market starts coming in. That's what causes those early liquidation breaks. All right. Odds of success increase if the prior day's structure does not support prior strong or weak settlement and the gap is just adding to the imbalance. So what does that mean? For instance, tells you that if let's say you're having a gap down, it's less than 10. So the first point has been satisfied. You have overnight inventory, 100% net short. Everything started from the prior day's settlement and they just started selling it. Okay? But, or I should say and, you look at the profile from yesterday. If there's something you can find in the profile that is some sort of a element of weak structure, so to speak, meaning that the market came down hard, closed near the lows, but the structure doesn't support it. So for instance, and we'll just throw out a couple of things that could have happened. The point of control didn't migrate lower with price.
Low,
right? The market closed at the low, and yet the point of control was 15 handles higher. Interesting. The market had a very, very overextended, stretched out, elongated profile that was very narrow. And yet it closed at the low. Tells you that the majority of the sellers from the prior day were short-term traders. They were just hammering it. They were just jumping on, hitting the bid, panicking all day long. No real other time frame money was getting in because, as we discussed, right?
Getting what's called short in the hole.
They got them, exactly. Short in the hole is when a market closes low away from value.
And by the way, we saw this exact pattern on Monday the 13th. Very bearish, very skinny, elongated profile. Then what happened the next day? Boom, ripped to the upside.
Boom, ripped to the upside, right. So if the prior day structure doesn't support the fact that the market closed low, that's better. Your odds of success increase, all right? Next, your trade location, and this is key because you're dealing with a gap down. So very, very often it's going to be tricky to kind of know where to get in, when to get out if you're wrong. Trade location must be close enough to the overnight low or the overnight high to allow for a proper risk-reward ratio. All that means is that the closer to the overnight high or the overnight low you are, the easier it is for you to place that stop because, in effect, that is really where your stop needs to be. Anything between wherever the futures are and where that overnight high or low is could be construed as noise because until that high gets taken out on a gap up, right, you really have potentially strong odds of still being right. But once that overnight high gets taken, and that's why the title of this trade setup is specifically fade that opening gap if the overnight low or the overnight high, does not get taken in the opening drive. The opening drive simply means that early momentum thrust. Call it the first 15 minutes. Usually it's the first 15 minutes of trade, sometimes as much as the first half hour, but you'll kind of know from experience what that opening drive is. It's basically just open, boom, go in one direction, etc.
Yeah,
you know?
and yesterday was a perfect example. I mean, we couldn't take out the overnight high. Market open, tried to get up, and then just sold off.
And just sold off from there, right?
So yesterday was a good example of this trade.
Internals should not be indicative, and this is a little typo there, I apologize. It says not be indicative of indicative, so kind of scratch that second indicative. Internals should not be indicative of ignoring the overnight inventory, especially the tick. Remember, of the three internals that we watch, the NYSE tick is the most important for day trading futures, especially the most important early in the day. And the reason for that is because it moves the fastest. You will not have good luck trying to figure out what the market is going to do in the next 5 minutes, 15 minutes, or 30 minutes if your eye is only on the breadth and the advanced decline line. The breadth and the advanced decline line are like the biggest ships. Remember, there's a hierarchy to everything. The king, the queen, the prince. The breadth is the king, the 80 line is the queen, the tick is the prince. But the king is old and fat. The queen, not so old, but still kind of corpulent. The prince,
Softy.
he's in like perfect shape.
Yeah.
He's like
Lean and
Arnold
mean.
Schwarzenegger at age 20. So he's going to like, boom, boom, turn around quick, fast in a hurry. Like, you know, it
That's
doesn't-
right.
Exactly.
Rock'em Sock'em Robots, you know.
Yeah, those things. Remember those
Those
things?
things.
You sit, sitting at the thing,
They were
hitting
the
the
best.
button. Those
Yeah.
are cool. All right, anyway. Or Hungry Hippos.
There you go. Whack-a-mole.
Yeah, all right, never mind. All right, we're getting off topic.
Yep.
But anyway, the ticks are going to move the fastest. So you're going to see a signal in the tick that you're not going to necessarily see in the U-vol, D-vol, or in the advanced decline line. So watch the tick very carefully. And as I was saying in the slide here, the internals should not be indicative of ignoring the overnight inventory, especially the tick. What that means is that if you're in a gap-up situation, right, overnight inventory is 100% net long. Okay, so those two things are satisfied. The gap is 7 points. Okay, great. So you got to be thinking, so now everything is setting up. You're thinking, and you're 2 points away from the overnight high. Great, everything's setting up perfectly. If I short it right here, I can put a 2.5 handle stop, whatever. But what if the tick opened at plus 850 and didn't budge? 15 minutes went by. The market was relatively flat. The gap's not filling. You may or may not have shorted already. Tick 850. Tick starts to break higher. Tick never comes down to zero. Zero negative tick. That's a red flag.
Yep, it's a
the
big
market
red
is
flag.
probably going to ignore the overnight inventory. Tells you that the overnight players, weak hands though they may be, tells you that they were right. They were right in buying the market previous. Market is ignoring that inventory situation. It's going to remain in bounds. Market probably goes higher and takes out that overnight high. So pay very, very close attention to the tick as it's happening. You want a tick that is supporting the fact that this overnight inventory should need to correct. That means that you want to say gap up 6 or 7, not take out the overnight high, and the tick should open up at like plus 150.
Yep.
So it tells
And then you
that
want to see them go red
exactly. It tells you that
immediately.
only the futures market is bulling the market up, but equities aren't really doing it. That disconnect is kind of there,
That's a great
and the
point.
market probably comes in a bit. So,
Good stuff.
all right. Now, targets, last piece here. Targets should be in stages. Prior high, prior low, value area high, value area low, and POC. You don't necessarily just want to cover all of it right at the prior high. Remember, the way Dalton looks at gaps, and I tend to agree, he thinks that there's a gap only if the prior high is taken out, not that you're gapping above the prior close.
Okay.
Remember, it can actually be looked at both ways. It's easier if the market gaps above the prior high because now you've got a really big gap to
definitive
contend
gap,
with to fill,
right.
right? And you can trade in stages, meaning, okay, my first target has to be the prior day's high. That's often a bounce. If we get below the prior day's high, come into the prior day's range, then go to the value area high. If I go through that, now I go to the point of control. And obviously, if it's very bearish and it looks like the market's just going to tank from the top, well, then you can hold for longer. But try to think in terms of these stages. And the reason I said this specifically in this slide, and I wanted to end with that point, I think it's really, really important, is because remember that a lot of these trade setups, which are specifically like the bounce off the value area high or low. Let's take like trade setup 1, fading that value area, right? Understand that those are the smaller trades. Very often that'll be 2 handles and out, 3 handles and out. But if you have a gap of say 8 or 9, and you're above the prior day's high. So remember, that means that you're 9 points above the settlement. You might be only 2 or 3 points above the prior day's high.
Right.
You have a chance to make 9 points. So you got to really be thinking about that, because in the bigger picture, in the bigger scheme of things, if this is what you're going to do and do nothing but this, you got to have a couple of those each month, and that finances the losers and the stop outs and all of that. So if you have that good opportunity where there could be that larger trade, think in stages. Take off a third at the prior high, maybe another third at value area high, see if we can get to the POC. It's a constant monitoring for continuation. That's a Dalton term. That's a Daltonism. I love it. I always give credit where credit is due. Jim Dalton always says that. If you go to one of his seminars or his webinars or read his stuff, he always uses this phrase all the time: monitor for continuation.
And one of the greatest tools we have are the internals, because you can watch the breadth and the AD lines and the ticks, and if you're fading those opening gaps, whether it's up or down, as long as the internals keep going in your direction, you can stick with the trade and then use those targets. You
got it. Exactly. That's right. Monitoring for continuation with internals and everything else. That's right. All right, we're going to take a short break, and then when we get back, we'll get into trade number 5.
Cool. See you in 90 seconds.
Early one morning the market was up. I was trading in bed, wondering if it all turned around, would my green turn to red? Looking all day at my positions, sure I gotta make a hedge. They never did teach me what I need to know, how to find that trading edge. Then I learned about Tasty Trade, following my muse, making my trades and I'm feeling fine. Lord knows I've paid my dues, never get the blues, tangled up in spoons. Soon I was trading better than ever, number of occurrences, trading small and trading often, like Liz and Jenny says. Couldn't ride the rails without thinking about Tasty, totally obsessed. Arguing with all my friends whether Slim or Tim is best. Trading all the time, I love it so much, cherry on my car. Checking Bob the Trader when I'm drunk down at the bar. When I take a snooze, I'm tangled up in spoons.
I told you we should have widened the strikes.
What happens when a good trade goes bad? Tom and Tony go over the positions that got them into trouble to keep you from making the same mistakes. Let's find out if we can take a trade that went off the rails and get it back on track. Watch Anatomy of a Trade, only on Tasty Trade.
ShadowTrader Uncovered. ShadowTrader Studios.
All right, welcome back.
All right, let's rock and roll. ShadowTrader Uncovered, live on the Tasty Trading Network. Breadth now 11.7 to 1 negative, improving slightly, 4.57 to 1 on the NASDAQ. Advanced decline line just sitting at the lows, just pegged at 2,200, so we could easily see lower prices into the close with these types of ADs. And tick distribution remains negative. I mean, we have very little positive tick action over the last hour or so, right? Last hour and a half, no bodies have closed above. No 15-minute bars basically have closed above. So very, very weak. Very, very weak on the ticks. All right, we are in the middle of talking about the, or I should say mine, not the, but my top 10 futures day trading, setups. We just finished with the first 4, and let's go over to number 5. Linda's going to give us trade setup number 5, which is, okay, here we go. It should be on the screen. All right. So the first, remember, where we left off after we did the first 4, we were talking about the fact that some of these trades will have larger expectancy than others. So for instance, Anytime you see the word fade, that could be a smaller expectancy unless it's like a big gap and you're going to try to make the whole gap move. But certainly like bouncing off the value area high from inside, et cetera, that's more of a fade move, could just be a couple handles. But of course, context is king, could tell you. But remember that some of these set up for larger trades, just like the last one, number 4, was a gap move. If that gap could be, anywhere under 10 points, could be a pretty large move. And this one is as well. This one is interesting. This is trade number 5, and it is literally saying trade number 5 is a pattern-based continuation or reversal trade according to a 5 or 15-minute candlestick chart. All right? Now, before you go and think that this could just be anything, you have to break this down into specific patterns that you think or that work for you, that you've seen work over and over. So I wrote down trend line using 24-hour data or just the regular trading hour session, consolidation breakout from a tight range, or buyers or sellers shut off pattern. So trend line using 24-hour or regular trading hour session is pretty simple. Either use a 24-hour chart or just that day's chart without the 24-hour data. Draw a trend line, buy or sell, touch of the trend line. Stop is usually, depending on volatility, no more than 1 point outside, basically. Don't let futures break that line by more than a point, etc. Consolidation breakout from a tight range. Perhaps you have a number of 5-minute bars or 15-minute bars that all have highs at the exact same point. That's important. It's not necessarily just a consolidation, but I should have added a caveat here that this is more about, say, a half hour goes by and you consistently see that, 1804.25 is a touch point and it touches 4 times in a half hour and it can't get through there. That's a trade. That's a consolidation breakout from a tight range. Obviously, once futures trade 1804.50, there's going to be a lot of pressure there and you usually get a lift out of that area. Reverse the situation for shorts. All right? Buyers or sellers shut off pattern. Again, we don't have graphics for this, but Brad and I have discussed this very often. 2 to 3, maybe 4, 5 or 15-minute candles down, all of them get negated by one big 15-minute bar up. Vice versa, few bars up, all get negated by one down. Probably very difficult for the market to get back up to that point where it started negating all that prior move. So you can open up a short anywhere in that area. Okay? Favor these setups if they are outside of balance, but they can be taken inside of the value area if it is apparent that the game is to get all the way to the other extreme of the value area. Thus,
that's a great point.
When you're out of balance, you always, no matter what, have a better chance of doing a directional play. These are essentially the directional plays, right? This is you see a pattern, it's either going to continue or reverse on that pattern. That's why I said it's a continuation or reversal trade on that pattern, right? This works better if you're out of balance. Makes sense.
And the reason being is when you're out of balance, there's either new initiating buying or new initiating selling.
That's right.
When you're inside of balance, it's just responsive trade back and forth.
That's exactly right.
So that is what you need to pay attention to. We're outside of balance. Okay, we just had 4 equal touches at 4.25, like Peter just said. 4.5, I'm buying. That's it. Because there's new initiating buying going on. Same thing for the short side. Just flip it.
That is correct.
Right.
So as I was saying, however, in that last bullet point, can be taken inside of the value area if it is apparent that the game is to get all the way to the other extreme of the value area. How will you know that? Well, once again, context. Remember, it is always easier to trade directional plays outside of balance, but as we know, there are times when the market is what's called rotational, meaning it rotates all the way from value area low up to value area high. It does happen, and vice versa. It can come from value area high all the way to value area low. Absolutely. So if, for instance, it's coming down, you have very, very strong internals. Even if you're in the middle of the value area, you have a pattern there. Seems like there's something that could be done there. Okay, you can probably take the trade. But you've got to have very, very strong internals that are indicating that the push is to get down to that other, get down or up to that other side of value.
And the other great thing about that point is it also gives you a great reference as far as where your stop is. I mean, if you think, all right, we're at the value area low, we're setting up consolidation here. The internals are improving. I think it wants to go to value area high. It's really simple. Your stop is below the low.
Right.
2 or 3 ticks.
Right. That would make it easier, obviously, if you were at value area low. But this trade is kind of saying this could be setting up anywhere. I was saying just like inside.
That's a good point too.
Inside the value area, just anywhere.
If
basically.
you're closer to the extremes, then you just put your stops outside.
Then stop could be just outside. That's right. That's right.
Yeah, that's another really good setup. But again, a lot of these are going to take time and practice for people to, see the setups, take the trades.
Most definitely. And as we go through all of these, remember that the key is to have the setups in front of you, get comfortable with all of them, paper trade the different setups for quite a long time to get very comfortable with them, so you know right away, aha, that's my kind of trade. That's the trade. And very often for a lot of people, you will not do all of the trades because you will not feel comfortable with them, because you'll find, for instance, like some people will say, well, I won't do the fades. I won't do the early fades because I'm a little bit afraid that the early momentum is going to be too strong and it's going to knock me out of the trade. Even if we don't take out overnight high or overnight low, a lot of times the action is very squirrely early and I'm not doing that. That's just fine. This isn't a situation where we're saying you have to do all of these 10 setups. I'm just telling you what I feel are the top 10 setups that work the best over time. You fit it to your own personality in terms of what setups you will or won't take during different trade sessions, and always keeping in mind that it's all about the context of each one. That the context of all these is gonna be different each time, and it really is king. It's the most important thing in terms of whether or not the trade setup is going to work. If everything was just pattern based, then you could just program any computer to easily recognize patterns and day trade all day long. That would be very, very easy to do. Certainly technology is way past that point a long time ago to be able to do that. But the reason that very few of those black boxes work is that it's very hard to constantly update and constantly be taking consideration of context.
And human emotion. I mean, it's just
exactly
too hard. You can't do it.
Exactly. So what we're going to do now is we're going to stop here on the 5, on the 5th one. So we still have 6, 7, 8, 9, 10 to go through. There's 5 more setups, and we're going to do those Monday.
That's right. This is great. And the other thing about all these setups is it's just giving you the framework for higher probability trades. That's what it's all about.
Right.
How can you stack the odds, the edge in your favor? I've been saying it for a while. What's your edge? You have to find trade setups that work. And on the intraday basis, we trade, overnight highs, first 5-minute highs and lows all day long. They work for me. That's what I found is my edge. And there's a lot of other setups that many people out there have. But if you just do these over and over again, keep the losses contained, you'll have winners that run. Like Peter was saying earlier, you get those 7-8 point runs, makes up for a lot of those small losses. You're going to be in a much better spot. And again, it's all about stacking the probabilities in your favor.
Right. Exactly. And also not just stacking, that's very true, stacking the probabilities in your favor, but if everything fits into a framework, even though the context is different every time, and very often the context will tell you that you can or can't take the trade or whether it works or not, just starting with the framework puts you so far ahead of the competition because you're no longer guessing. You're no longer just coming in cold and trying to play momentum. You're not chasing momentum. That's the thing. If you don't have a specific setup and you just chase momentum, say, oh, I think these futures are bullish. I'm going to buy some down here. I'm going to sell some up here. That over time, I think, can be a recipe for disaster, because the markets do shift and change really quickly and you get caught out there and you don't really have a plan. There's no real concrete reasoning for why the trade was taken. It could be problematic, I think. So working from that framework, I think, helps a lot.
That's a great point. And by the way, obviously, as we were going through these setups, I'm sure many of you were feverishly taking notes. Rest assured, you don't miss anything because you can go back and rewatch this segment just like you can every day at Tasty Trade.
It'll be posted at tastytrade.com, usually by the end of the day, 4 or 5 o'clock Eastern. It's there. Just click on tastytrade.com, click on shows, and scroll down to the bottom to ShadowTrader Uncovered.
Yeah, because I'm already getting tons of emails like, are you going to replay this? How can I see it? I'm sure it's a lot of the newer folks, which is great, but don't worry about it. It's going to be there for you. Tastytrade.com shows.
All right.
So there we go. We got 5 out of 10 out of the way. We'll continue this on Monday. We really appreciate everybody hanging out with us. And where do I start?
It's coming up
next with Tom and Case.
See you guys next week.
Have a great weekend. See you.
Bye-bye.
ShadowTrader Uncovered. ShadowTrader Studios.